Hey everyone, and welcome back. Today I just wanted to briefly go over the whole reverse repo market situation that is going on right now. Now, before I dive into that, it's important to know what a reverse repo is. It is just the opposite of a repo, which is where the Fed takes in treasuries and gives out cash or liquidity in return. So the opposite of that would be the Fed taking in cash and giving out treasuries in return. Now, why would anyone do this? Well, in short, lack of collateral and the cash has nowhere to go because there's simply too much of it, right? And if this cash were to go directly into the economy, well, inflation is already a really big topic. Wouldn't want that getting out of hand, even though it kind of already is. So parking that with the Fed overnight is the better option for both the financial institutions and also the Federal Reserve. But we see that the amount of cash that is being parked with the Fed overnight has reached a new all-time high of $485.3 billion compared to the previous record of $474.6 billion set back in December 31st of 2015. And I mean, we're talking about a repo facility that has barely been in use just as recently as 2 months ago, and now all of a sudden we're at a new all-time high. And usually this is something we would see at the end of the quarter if it happened at all. It doesn't have to, but if it does, it usually happens at the end of the quarter. Problem is, we are a month away from the end of the second quarter, which begs the question, how high can this go? And then also, how bad is the situation? And in short, it's really bad. There's a lot more nitty-gritty details to this, but I'm just going to get straight to the point here. The Fed is in a really bad situation. And the higher this goes, and I anticipate it will go higher, puts a lot more pressure on the Fed to do one of two things. The first option is to raise interest rates and taper asset purchases. Something they should be doing anyways, but that would be their first option. And obviously, this would discourage reckless borrowing because interest rates have gone higher, and it would really take out unnecessary excess in the markets, which is something we desperately need right now. Although I'm not even sure it's possible to do this without just imploding the whole entire system. So that's kind of an unlikely route that they're going to take. If they do, it's going to be probably very minimal, and then they're going to backtrack really quick. So that's the first option. The second option is to keep doing what they're doing and allow the situation to even get more out of hand, have the system just drowned in liquidity, and allow rates to go negative, something they also do not want. But the higher this reverse repo figure goes, it puts a lot more pressure on the Fed to act. And it's going to be really interesting to see how all of this unfolds because we have the June FOMC meeting coming up here in a couple weeks, and then shortly after, Jackson Hole. So yeah, I mean, I think we are pretty close to a turning point here. As much as the Fed has said they are not expecting any interest rate hikes until next year, the year after that, this may force their hand. I mean, there's simply too much liquidity out there, and if you haven't seen the economic data lately for inflation, it's not good. Anyways, that is pretty much it for me. If you guys have any questions or comments, feel free to reach out. Please like, share, and subscribe, and I will see you all in the next one.